All right. Hey, Hunter. Looking forward to today's podcast. I think we've got a topic that certainly has been driving the market, for probably the last couple of years now, and that's really the Fed and interest rates. And now, instead of interest rate hikes, we are looking for that interest rate cutting cycle. It is finally happening, or at least we think it's happening. Seems more sure than not. And so looking forward to that. And as a reminder to our followers, if you will like and subscribe, and then drop comments if you have any topics you'd like to hear Beckonomics cover in the future.
Yeah, and the markets certainly think it's going to happen. Whether or not the Fed is 100% sure, the markets are pricing in 100% chance of a rate cut in September and looking for another one, at least in December. That's kind of the general thinking right now, is 125 basis point cut in September and then another in December. So that's notably leaving out the meeting we have at the end of July, as well as the meeting we have in November. So two for this year, which is a lot fewer than we were expecting coming into this year, but really starting that pivot that everyone's been waiting for a long time now.
Yeah, and as a little bit of background, just for all of our listeners to remember, 25 basis points, 1/100th of 1%. So you're talking about 0.25%. Right now, the Fed funds rate sitting in this target range of 5.25% to 5.5%. So we are really looking at, and kind of what the Fed has been forecasting are these roughly quarterly 25 basis point or 0.25% cuts on a go forward basis. That's kind of how they finished the hiking cycle, was with 0.25% increases. Now we're looking for those 0.25% decreases as they get in this cutting cycle. And I think what comes to top of mind is why is this finally happening? Why is it happening now? It's really interesting because the market going into this year, following the December Fed meeting, everyone saw a super dovish Powell. And by dovish, of course, I mean that the Fed is looking for easier monetary policy, lower interest rates. It really seems like back in December, the Fed liked the path of inflation. They were kind of ready to start rate cuts. Market was pricing in anywhere from 5 to 6 25 basis point cuts this year. Well, of course, year to date, we've had 0. So now we've finally gotten to this point where the Fed is satisfied with the inflation battle. Their preferred gauge of inflation, which we've talked about before, is that personal consumption expenditures index, or PCE. And that's finally come down to 2.6% year over year was the latest reading. And that is really close to their 2% target. So they're finally satisfied with that. The other part of that, and as we've talked about before, but I'll kind of remind everybody, is that the Fed's got that dual mandate. So they're looking at inflation, which has really taken the headline by storm, and then unemployment. So they're trying to balance those two things out. The reason that they've been able to hold off on these rate cuts for so long is because that employment piece has stayed really robust. Labor market's been tight, unemployment's been low, and so they really haven't had to cut yet. But, and something that I'd love for you to walk through a little bit is the market is a little bit concerned about that labor market piece. It's been softening a little bit. And so now is really a good time for the Fed to go ahead and start cutting.
Yeah. So on that dual mandate that you're talking about, now that really one of the big pieces of that PCE, the shelter costs have started rolling over, as we've all been waiting for 6-9 months now. Now that that's actually rolling over and PCE has really resumed its downward trend, the focus is a lot less on it and turned a lot more towards the labor market, where unemployment has, picked up a little bit from really, really low levels. So labor market was very tight. There's, lots of jobs, few job seekers. And now that unemployment rates ticked up a little bit, and we're basically at the Fed's target rate for unemployment. And so the concern with unemployment is that whenever labor market, loosens, it generally loosens very fast. And so we're kind of in this period where everything's still Goldilocks. We're at our unemployment thresholds. But the concern is, turned more that direction because the PCE has resumed this downward trajectory. We're at 2.6, targets 2. and we have that tailwind of the shelter piece coming through for us.
Right. And I think going on from that, it's important to talk about why does this matter? What kind of impact does this have, if you will? So we, of course, from an investment lens, are looking at which companies we're investing in. But yeah, I'd love to talk through some of the sectors that we're looking at. And the first that kind of comes to mind to me is your corporate borrowing piece. So as interest rates get cut, the Fed funds interest rate lowers. That's the very front of your maturity curve. If you're looking at credit, and pretty much all corporate debt, all U.S. debt in some form or fashion is really based off of government yields. And so once that Fed funds rate comes down, it's going to kind of bring everything else down with it. And a big piece of that is that corporate borrowing rate. So typically when you're talking about the credit worthiness of a corporation, there's some kind of spread, some additional interest rate, some additional percentage points that you're going to pay over what the government rate is. And so as that Fed funds rate comes down through the progress of this Fed cutting cycle, it's going to make it cheaper for corporations to borrow. And the bigger piece of that is that all of these companies, so many corporations, really piled on their debt and refinanced during that COVID period when you were talking about investment grade corporate debt was 3% or less. And now you're talking about it's really in that 5 to 6% range, maybe slightly higher depending on the company. And they don't want to refinance all of their debt at those levels. Those debt maturities from 2020, from even before that, are starting to get there because they're looking at 2025, 2026 for a lot of this debt. And they don't want to have to refinance at these higher rates. A lot of companies have been using revolvers and other kinds of short-term debt to really put off having to, put longer maturities out into the marketplace. And so it's going to benefit those companies that have those higher debt burdens who are concerned about turning over that debt at what is now high interest rate.
Like you were talking about, people have been expecting these rates to come down for a long time. They've been putting off locking in at these high interest rates. And so they're just waiting for the Fed cuts to put on any longer duration debt. And so because we were expecting at the beginning of the year 5 or 6 cuts in 2024, and we're looking at getting 2 now, it's pushed everyone's expectations forward. And it's really this holding period of, short-term debt has been really rolling over. And so as soon as we start getting cuts, it's going to take a lot of pressure off these predominantly smaller companies who rely on debt financing a lot more. One of the big reasons for the mega cap outperformance over the past year is that these companies aren't reliant on debt. Debt burden is not a big deal to them. NVIDIA, Apple, they have more cash and cash flows than they know what to do with already. So paying down and servicing their debt isn't really an issue for them, whether it's at 4% or 8%. But your smaller companies, your Russell 2000s, your Russell lower part of your Russell 1000, debt means a lot more to them. Even bottom half of the S&P 500. I mean, you get out of those mega caps, and debt is a big part of the balance sheet, and that's something that makes a big impact on investment decisions and expansion for these companies.
Yeah, and I know that we talked a lot about that in our recent podcasts on the widening breadth of the market rally, and I think that's absolutely something that's these Fed cuts are going to impact. I think another area of interest that has been really hurt by interest rate hikes that could benefit from interest rate cuts are the banks. You've seen a lot of banks under a lot of stress. Even the Fed had to rework how they kind of calculate bank balance sheets because of the impact that these rising rates had on those bank balance sheets and the impact that it had on government treasuries. But banks traditionally, if we think about their business model, they're taking in money on a short-term basis. So a checking account, a savings account, that's all short-term money that they, at the end of the day, they owe back to the consumer. And what they're doing with that is they're lending it out at longer-term periods at a premium to businesses, to individuals. And what they hope to benefit from is that spread in interest rate. They can loan out money for a longer period of time at a higher rate that they can give people on their savings account or their checking account. Well, the problem is what we've seen with the yield curve through the Fed rapidly hiking into this new environment is that short-term rates are just as high or higher than those long-term rates. So not even talking about legacy assets that banks hold on their balance sheets where they were lending out money at 3% and now they're having to pay out savings at 5%. But if you just look at it today, I mean, the 10-year treasuries, sub 4.5%, whereas the short-term rate, like we just said, Fed funds rate, 5.25 to 5.5, and banks are having to at least pay out on savings accounts, call it 4%. So the amount that they're making by lending out money at longer periods of time is really, really tight spread. And so banks have been really hurt by this rise in interest rates. And that they're excited for the lowering of these short-term rates because they're not going to have to pay consumers so much on their savings. They're not going to have to, borrow overnight at such high rates. What they're going to be able to do is give less dollars to those in savings accounts and CDs. And then the long end, the longer maturity debt that they've already lent out, that they continue to lend out, is not going to drop as fast as what the Fed is going to do to the short-term part of the curve. And so they'll finally make a more attractive spread on those loans, and it's really going to help their businesses. We've seen a lot of bank stress, bank failures over the last couple of years, and it's going to be really beneficial to have that for the banking industry.
Yeah, it really will be for the banks and also for the consumers themselves, because part of this calculus is banks don't like the current shape of the yield curve with these longer term rates where they're lending being lower than the short term rates where they're borrowing. But also the consumers, just the broad heightened rates make it really difficult for consumers to finance purchases, whether it's homes, kind of like the bank context, but also autos, and then smaller home projects, home renovations, swimming pools, whatever it is that traditionally gets financed for any amount of time, makes it really prohibitive for consumers to take on those projects right now. This is something that we talked about in our latest quarterly newsletter that we put out, but it's we've seen a drying up for demand in a lot of those consumer products that require financing. And as soon as rates come down a little bit, we're likely to see that pick up, or at least we're expecting that to pick back up.
Right. I mean, why would you put in a new pool or buy a new car if your financing all of a sudden is at 12% instead of maybe what it was a couple of years ago at 5%? I mean, it's just all of a sudden it really doesn't make financial or economic sense. Sure, if you can pay cash, great, then the financing is not a burden to you, but it makes a lot more sense whenever you can get an attractive interest rate. I think another area of the market that is going to benefit from this, that we've kind of been talking about a lot of headlines around, is commercial real estate. And now office space is a little bit different conversation just because of the more macro themes around that. People aren't going into the office as much anymore. More people are working from home. The office sector is kind of that taboo, untouched sector of commercial real estate right now. But across the other valuable pieces of commercial real estate, multifamily housing, industrial, data centers, hospitality, commercial real estate in general, it's a yield product at the end of the day. So you're talking about how much cash flow is this property generating and at what price? Basically your PE multiple, for a commercial property. And people in real estate, native world are going to refer to that as essentially a cap rate. But it's the same kind of structure, but it definitely gets impacted by interest rates. And so when you talk about higher interest rates, it's more competition for those as investment vehicles. And what we saw over the really low periods of interest rates, call it, pre 2022, before the Fed rate hiking cycle, was that cap rates had shrunk so much. You're paying so much for that small amount of income because you're talking about the yield that you're generating when you're competing against treasuries and corporate debt that's yielding 2 or 3%. you're going to pay more for that cash flow that's being generated by those properties. And so those, first of all, the valuations got extremely high. We've seen those drop as interest rates have climbed, but that's going to be a benefit, finally again, because whereas those valuations dropped while rates were increasing, we're going to see them rise as rates decrease. And then the other side of that is that whenever these real estate companies are financing their debt, it goes back to the whole corporate conversation. Finally, they're going to be able to refinance that at lower rates instead of these high rates that we're experiencing right now.
Yeah, exactly. So that's going to be big for basically the whole economy, as we've touched on, but that's just the private sector. Moving on to the public sector, the government spending, as we mentioned or really delved into in our last podcast or a previous podcast, is the issue of government borrowing. And so right now that's at a really high rate, and it makes it very expensive for the government to address, the spending needs, because about a quarter of our budget is financed at this point. And so that makes the debt burden or interest expense on that is about the same size as our, non-defense discretionary spending. That's a huge amount of the US budget, and it's only increasing at this point because rates are so high. So once those come down, that'll be less of an issue. It still needs to be addressed, but for that conversation, I'll have to go back and watch that podcast because we can't rehash it here. But the point is that that's such a big issue for all of us, because whether you like it or not, money is being spent on my behalf, on your behalf, that is being financed at really high rates. So that as that comes down, it'll make it easier for everybody across the board.
Yeah. So clearly a lot of benefit to a dropping of rates. Now, I want to get into a little bit of forecasting. Now, clearly, the broad marketplace is not very good at forecasting an interest rate path because, like we just talked about, back in December, most people thought there was going to be anywhere between 4 and 6 cuts this year. Now we're looking at 2. So most of Wall Street was very far off on this. I think the path is a little bit more certain now, just because once the Fed starts cutting, they're really going to want to go on this kind of quarterly pace. But we can probably more than likely expect 2 cuts between now and the end of the year, bringing us down from 5.25 to 5.5 to that 4.75% to 5% range. Then I think what we're looking at, what most market participants think, is based off of that kind of quarterly rate cut, 1 percentage point of cuts in 2025, 1 percentage point of cuts in 2026. And then the question kind of becomes from that point, where is the Fed's ending spot? Well, they're not going to go back to 0. We've pretty much heard that from every Fed official out there. I don't think anyone should be waiting for interest rates, like I said, that Fed funds rate to go back to 0. I don't think we're going to see 2 or 3% mortgages for quite some time unless there is some kind of significant recession, in which that case, none of us really want to see that either. And so it's really about planning out, hey, how much is the Fed going to cut and how fast? And I think that's kind of what the market's looking at right now. But of course, it's going to be, as the Fed likes to say, data dependent as far as what inflation and the labor market do and just how that path looks kind of on this ongoing basis that they're going to evaluate at every single meeting.
Yeah. So I want to get into the implications for the stock market now. We're have an expectation for the future, from private market expectations as well as the Fed stock plot. And so for the stock market itself, what we're really looking at Beck Capital Management is those cyclical sectors that are going to benefit the most from interest rates. You have kind of back to the commercial real estate, excluding that kind of office piece that people are concerned about, and some of that retail, like where malls would fall into, the really out of favor stuff. Looking at anything that's, high dividend payers are going to benefit from this. Small cap companies, we talked about those debt burdens lightening up. A lot of places to look at in there. as far as, utilities even. That's a separate conversation that we've had in previous episodes about increased demand from data centers and AI, but also because they're generally low growth, dividend paying, pretty safe companies, but they have actually a couple of tailwinds going for them right now. But without getting too much into the weeds and too finite details, it'll really provide a tailwind for the next couple of years, 2.5 years at least, while we're forecasting those kind of quarterly cuts going on.
Yeah, I think it provides, like you said, kind of an ongoing light tailwind for markets. I think we still are in a somewhat precarious economic situation. So it's going to be really important to see, call it the first full percentage point of cuts over the next year or so, how those play out, because that's where the data is going to be very sensitive. The market's still trying to figure out what kind of direction it's taking, whether it's consumer strength, the job market, inflation still has a slight question mark there. We think that it's really on that glide path to 2%. But there's always a question of, hey, if inflation actually ticks up next month, does the Fed say, hey, we don't want to do September anymore? These are things that could potentially happen. So it's something that, we're going to have to be on our toes as far as investors through this market cycle. And then going back to what you're talking about, cyclicality of sectors, individual companies, I think is going to be important to look at. Like we were talking about earlier, individual balance sheets really matter in this kind of scenario. And so just looking through, doing the work to analyze, hey, which companies, which sectors, and then those kind of sub industries of those sectors are going to benefit, because there's going to be winners and losers, just like in any market cycle. And I think it's going to be exciting and kind of a more interesting environment to be investing in as we get a little bit back to those fundamentals of investing away from such a Fed-driven environment. But we're still going to have to watch that macro along the way.
Yeah, to that point, I think we're getting back into that kind of stock picker environment. It's going to be a lot more fun because it's not just all Fed-driven like that.
Yeah. Well, Hunter, thanks for running through this topic with me, and thanks to all the listeners out there. Again, like and subscribe to the podcast, and let us know if there's anything you want to listen to on future episodes.